Hi everyone, and welcome to ACCA P4, the Q&A session. Okay, for this 30 minutes, I would have to be with you. The objective is to answer any specific questions that you have in relation to whatever we've done so far. So if I have to refresh your mind on what we've done investment appraisals basic, we've done MPV, internal rate of return, modified internal rate of return, duration. We went through inflation, capital allowance being claimed in advance, capital allowance claimed in arrears. We've also gone through free cash flows, and in calculating free cash flows, we said that is what we will need mainly for calculating the value of a company. And that can be done as the present value of the free cash flow discounted using the WACC. And when I get that PV is equal to the corporate value, that corporate value is made up of value of equity and value of debt. So if I want the value of equity, I would have to deduct the value of debt out of it. And then when I get the value of equity, there's another way I can calculate the value of equity using the free cash flows to equity method. Okay, we also did cost of capital, and then we are able to do up to the project specific cost of capital. So for now, I am going to invite you to bring whatever questions that you have. Okay, so anybody having any question, you can bring it up and then we will discuss. Otherwise, I am going to pick something that I think is a bit technical that most of you might not be able to actually appreciate it straightforward, and I'll keep on discussing until anybody has got a specific question to ask me. Okay, whatever I have taught so far, the area I think is new to most of you is in relation to calculating the cost of capital using the principles of Modigliani and Miller. Okay, Modigliani and Miller and their capital structure theory. Okay, there's a question up now here. So the question here is, I should explain briefly how the exam questions will include topics. Okay, so far as your P4 exams is concerned, the examiner really expects you to appreciate cross-section of the syllables. Okay, so it's not normally a situation where you're going to get one question from a particular area, even though the principle he's using to ask the question is this. If you want to test something on, let's say, investment appraisal NPV, okay, you will need, or you will see the question mainly as NPV, but he will ask you to also calculate the cost of capital. So this is where he will expect you to combine the principles of the NPV and the principles of the calculation of cost of capital. And for instance, he might create a scenario such that the company is currently operating in this industry, and now they intend to do a new project, and they give you the project selling price, variable cost, specific fixed cost, tax savings on the capital allowance, working capital. You get the net cash flows for the new project. What WACC are you supposed to use? Examiner will intentionally trick you by giving you the company's current WACC, but that current WACC would have reflected their existing business and financial risk. In that case, their current WACC will not be appropriate. I would have to get the WACC that is specific to the business and financial risk of this particular new project. So the examiner will hide the calculation of the project specific cost of capital. So when he hides that, the moment you have to calculate NPV, and as we said, you need your number of years, relevant cash flows, and the appropriate cost of capital. So if he gives you the current WACC and you see that the new project is a diversification away from the mainstream activity now, business risk is changing, and as such, we would have to actually come out with a project-specific cost of capital. Okay, so you get your proxy beta from the industry the new project is supposed to be undertaking. If that proxy beta is actually geared, you would have to ungear it. If you will have debt, you will have to re-gear it to bring your own financial risk. Put it in the CAPM, get the project-specific work, use it to discuss it. So the questions are going to be inter-topic related. If you are doing mergers and acquisition, you will need to what? Value the company, which we haven't done so far, but because of the question, I'm bringing so many things in. You have to value the company. To value the company, you will need your free cash flows. When you get the free cash flows, you have to discount it using WACC. Examiner can also decide not to give you the WACC. Examiner will not give you the free cash flow. So you have to bring your chapter 2 and whatever you'll be learning in mergers and acquisitions. Okay, sometimes when we are doing investment appraisal and it's international investment appraisals, exchange rate will come in. When exchange rate come in, we have to determine the exchange rate. Sometimes the examiner will link exchange rate risk, which is going to be with the swapping. Okay, so my advice to you is when you are learning the topics, as at now that we are teaching them topic by topic by topic. But together, when you are learning, ask yourself, how does these topics interrelate to each other? And then you'll be able to establish that relationship. And that is what the examiner will use to set the question. But every question, the focal point will be on a particular topic area. Let's say investment appraisals or mergers and acquisition or hedging. But definitely, he is going to bring the application of other topics in order to form the whole question. Another question has also come up. What are advantage of protectionism? Okay, advantage of protectionism. First, you need to ask yourself, as I normally explain to students, when you ask me a question and I would have to answer it, I don't just go straight and I answer that. That's my style in even answering questions in the exam room. Okay, when you ask me a question, I lead myself. So if you ask me what are the advantages or disadvantages of protectionism, my first question to myself will be, especially if the student doesn't know straightforward, your first question to yourself is, what is that protectionism? Protectionism occurs where companies in an attempt to protect their local industries, countries in an attempt to protect their local industries, they will block other foreign investment or other foreign companies in establishing their business in there, or other companies or foreign companies exporting their product into that particular country. So when you are using protectionism, your country doesn't open up for foreign goods to come into your country. It has good sides and it has good bad side. One of the good sides is that if you are protecting your local industry for which no other foreign goods are coming in there, it creates what? Employment for that particular country, because you are actually manufacturing everything in there. It's got this and that. Employment has got this and that. Because if you don't protect, one problem is that your local companies will not be able to compete with advanced companies in other countries, because they might be producing for a very long time and they are enjoying economies of scale. So their cost for producing one unit is going to be less than the cost that your local industry or your local companies will be able to produce, and as such they can't compete. So when you bring in those foreign goods, it will be cheaper than those produced in your country, and as such your local industry is going to be dead, and employment of course is going to be a problem. Okay, and then also when you protect that particular industry or particular companies, or you protect your country, it avoid dumping unnecessarily product into your country. If you go to most developing countries, you see most cases a second-hand product that goes in there. Second-hand cars, second-hand computers and all that. So when you open, that your country will be a dumping place, because some developed countries, they might have so many and they want to have new product. The moment new product comes in, old products are supposed to be what? Dumped. Where should they dump them? Dumping them in a developed country is especially expensive. So one easy way is that, okay, let's go and sell it cheap in the developing country. They will be able to make money, and that will also be sort of a trash for them to be putting their the dumped or the unnecessary product. So that can also protect you bringing in inferior or dumped product. The other side of it is that when you open up, it creates competition, and competition actually leads to increased efficiency, because the home country product are produced locally using maybe local resources. If foreigners are supposed to come in to compete with them, they would have to get a way of reducing costs. One way of reducing costs is to improve efficient use of resources. So because there's competition, there could be that efficient utilization of resources, and as such, the raw materials or resources of the country can be used effectively or efficiently in order to achieve maximization out of those particular efficiency. If you open, it might also create jobs, because maybe that foreign companies now they wouldn't produce in their country and they want to export it. They might establish a foreign subsidiary in that particular country. When they stay in that country, of course, they will employ local labor, and labor, of course, employment is also going to increase. So there are so many benefits. That's why I keep telling students, what you have to do is when they ask you a question and you are not able to have the answer straightforward, step back and then deduce and bring yourself to the level. What is that thing? Protectionism is me protecting my local industry by preventing foreign companies to come into my country. If I should do that, how will I benefit and how will I get problems? This is the argument. So is there any other questions that we can actually? Okay, dumping, as you said, dumping, please explain. Dumping means that the second-hand product or product which are just about to be treated as obsolete because they don't need it in country A, and you have opened up, they can bring all of them down there to you, and then you would have to sort out with how you they are seized on the land and then landfilled, and they use some of these chemicals or some of these products and then use it to fill those in the developing countries. So it becomes a dumping place for obsolete product. Okay, if you go down there, you see very old computers and all that. Second-hand product normally goes down there, and as such, this is a way of actually disposing of that particular waste product. Okay, any other question? Any other question? Okay, any other question? Right, if there's no other question, then let me bring you to the Miller and Modigliani, because most of you haven't met them before. And my whole problem is, how will you be able to see Miller and Modigliani in the room? To see Miller and Modigliani in the exam room, the question created should be giving you movement of gearing here and there. Am I geared and I want ungeared? Or am I ungeared and I want geared? The moment you read the question and you see that your business risk is going to change, your financial risk is going to change, then to calculate the cost of capital before and cost of capital after, Miller and Modigliani is calling you. Okay, one of the questions the examiner created was the company was actually having a property. The company was having a property and hotel business. So they were doing the two together. They were having property and the hotel business. And the property business that they are having, this is the property, and then having hotel. This is what they were doing now. Now, the directors of the company, they were proposing that they are going to sell the properties. And when they sell the properties, whatever sales proceeds they will get from the sale of the properties, they are going to use to pay off 70% of the debt of the company. And they gave further information, and the requirement was you calculate the current cost of equity and WACC, and the revised cost of equity and the WACC. Okay, most people couldn't see what the examiner was trying to imply, because as I told you in the lecture, the examiner is not going to mention Miller and Modigliani. If you are doing properties and then hotels, and you want to sell the properties, if you sell the properties, whatever monies you use to pay 70% of the company's debt, it means if you pay the 70% of the company's debt, your debt equity ratio before is not going to be the same as your debt equity ratio after. Therefore, financial risk has changed. Miller and Modigliani is calling you. Secondly, my business risk has also changed, because my company was doing this too. So my company business risk would have been business risk from the properties and business risk from the hotels. Therefore, if the property business is disposed of, my new company will not have the properties. They will now have only what? The hotels. So if you tell me to calculate the WACC here and the WACC here, my simple common sense is my WACC here will now reflect my business risk and my financial risk. And my business risk here will be made up of business risk of the properties and business risk of the hotel. And my financial risk will reflect my current debt equity ratio. This is how I would have to use to calculate my WACC. So if you give me a cost of equity, or you give me beta, if you give me cost of equity, examiner is pushing you towards the prepositions we learned. And once I need cost of equity revised, I would have to be thinking of what? The preposition to. If you give me beta, then it's moving me towards geared and ungeared betas. So whether you use the preposition approach or the geared and ungeared betas approach depends on what the question had given to you. So if you give me the beta, equity beta of this company, let's say equity beta of this company is 1.8. Because this company is having debt, its equity beta measures both business and financial risk, and as such it is geared. So if I want my current cost of equity, I can pick the current equity beta, put it in the capping formula, that will give me the current cost of equity, and I will calculate the current cost of debt. When I get the current cost of debt, I put the cost of equity, cost of debt, market value of equity, and market value of debt, and I weight them together. That will give me my current WACC. Now, if we sell the properties out, that property is gone. My company is having only hotels. So if I'm having only hotels, my new WACC should reflect my revised business risk and my revised financial risk. So what will be my revised financial risk? My revised financial risk will be my new debt equity proportion. And the question told you, you are paying 70% of the debt. So if you are paying 70% of the debt, your new debt equity ratio, it means your debt will remain 30%. He didn't say you are paying 70% of the total capital. You are paying only 70% of the debt. So assuming my debt was 100 and my equity was 200 before, what will happen? Let me do it here. If my debt is 100 and my equity was 200 before, If I pay off the 70% of the debt, 70% of the debt, this one will go, so I will get 30 here, and then this will be 200. This will be the new debt equity for that. Okay, question is coming. Let me see. Okay, I will answer that soon. Okay, so what is happening here is if I pay 70% of the debt will be remain 30%, and 30% of the 100 is 30, and your equity is 20. Your debt equity proportion has changed. It means my financial risk has changed. Okay, now what is my business risk? My business risk will relate to only the hotel. So if my business risk will relate to only the hotel, then how much of this 1.8 relates to only the hotel? This 1.8 was geared, which reflected the debt equity of this word 100 and 200. I would have to ungear this. If I ungear this using my current debt equity proportion, it will give me the beta asset or asset beta that is measuring only my business risk. And currently, my business risk is made up of business risk from the property and business risk from the hotel. I don't need the business risk from the property. I need the business risk for the hotel alone, because my revised company is now made up of only what? The hotel. Examiner will give you the basis that if I have got, let's say, I ungear this and I got the business risk to be 1.5. This 1.5 is measuring the business risk in the property and the hotel. How much of the business risk of the 1.5 relates to the property? If they give you the business risk related to the property, you will be able to get the business risk related to the hotel, which I will show you probably Thursday how to get the business risk of the combined. Okay, so if I give you this and I get this H business risk is what my company is going to face. So when I get this business risk for the hotel, that is what my company is facing. But my company will also have debt of 30 and equity of what? 200. I need to re-gear and then put it in the capping before I'll be able to calculate the WACC. Questions have come up. First question was that if I calculate my cost of debt wrongly and I calculate my cost of equity correctly and I have to calculate WACC, am I going to get the full marks? Okay, for the WACC, yes, you will get the full mark for the WACC, because the principle of ACCA marking is not to victimize you twice. So to calculate my WACC doesn't come by itself. I need the cost of equity. I need market value of equity, cost of debt, market value of debt, isn't it? And when I weight them together, that should give me my WACC. So if I calculate my cost of equity correctly, I calculate market value correctly, they don't mark the WACC. There's a mark for this, there's a mark for that, there's a mark for that, there's a mark for that. So if you get your cost of debt wrongly, they will victimize you for not being able to calculate the cost of the debt. Therefore, when I put my wrong cost of debt in the WACC formula, I have already been victimized by losing the marks allocated for the cost of the debt, because that is what I wasn't able to calculate. But I knew that within the WACC, I need to bring down my cost of the debt. Therefore, my wrong cost of the debt, if I put it in the WACC formula and I calculate the WACC, whatever marks is allocated to the WACC, I have to get it for free of charge, even though I got my cost of debt wrong. This is what I tell students, that when you go to P4 exams, some of these things I will handle them when we're doing the revision, and then I pick the questions. You will see how I'll do it. You are not expected to get everything right. And some of you, whilst you are calculating something, you want to get it right. So you tempt it one, it doesn't work, and you waste all the time on it. How many marks will that particular give to you? No way. Okay, how many marks will that particular give to you? Move on. I tell students, if I have to calculate the WACC and there's no way I'll be able to calculate the cost of debt, what will I do? But I need the debt in there. You do something. Sacrifice the marks for the cost of debt. Move on. Go and calculate your WACC. and then you get the full marks in there. Okay. I'm confused by the cost of equity formula where D0 is equal to current dividend and the answer. Okay, yes, I think I saw your email this morning. Okay, but I was lecturing this morning. That's why I couldn't come back, because I wanted to come back this evening. It's good that you had actually asked that. Yes, when you are using dividend valuation, according to the dividend valuation, the value of the company is the present value of the future dividend. So when I say P0 is equals to D0, 1 plus the growth rate divided by the cost of equity minus the growth rate. Okay, this is my present value of the future dividend. It is out of this formula that they calculated the cost of equity. Or you could have said P0 is D divided by the cost of equity if the dividend is constant. So if the dividend is constant, my cost of equity should be D divided by P0. And that is why we said this P0 should be always X. Okay, now be with me and the difference. The difference is that this market price we're saying is the X, is the present value of the future dividend. But throughout, you see the formula we put here, D0, throughout from F9 up to this level, they assume that, oh, your current dividend is what is going to be the base for your future dividend. But it doesn't necessarily mean that. If I go to the room and the examiner gives me my current dividend and he gives me my future dividend, what I need in the formula here is the future dividend, because this is telling you the present value of the future. So what you need as dividend in the formula is the future dividend. So when they separate them for you, you should be able to separate them as well. And bringing you back to, is it Berlan question in our note, according to you, 104, I can't remember, good. So Berlan, the examiner told us that the cost of equity that we have to calculate, we were using the dividend valuation. And the examiner told us that all earnings will be paid out as dividend. So if all earnings will be paid out as dividend, and he gave us the current profit before interest and tax, and told us that that current profit before interest and tax is going to stay constant to the foreseeable future. It means my future dividend will be equal to my future what? Profit after tax. And that same question told us interim dividend which is supposed to be paid now is, I think it's 6 cents or something. So if it is 6 cents, that 6 cents is the dividend to be paid now. I don't need that dividend here. I don't need that dividend of 6 cents here. I need the future dividend. And that future dividend is what the question told me I have to get the earnings in the future, because all earnings in the future will be paid as dividend. So the D I need in the formula should be the future dividend. However, in the P0, we said it should be XDIV. And what is XDIV? XDIV is the cum div minus the current dividend, because the P0 is the present value of the future dividend, and as such it does not include the current dividend. So if I've given you the cum div, that cum div is the market price, which is made up of the future dividend plus the current dividend. I don't need the current dividend in there. I need the X. So the cum div minus the current dividend should give you the X. Therefore, if I want my P0, then I will say my cum market price minus the current dividend. But if you see what we've been doing, because they don't separate these two for us, whatever we put in the D0 formula here is the same as what we put here to deduct. So when the examiner change the two, separate the two for you, you also have to separate. And that is the meaning behind that. Okay, so that is the case. So D0 should be your future dividend. And the dividend you need for the XDIV should be your X. Okay. how to prove the power formula mathematically, that is 4/5 raised the power that. Do you want to solve it? If you want to solve 4 divided by 5 raised the power 1/5, the meaning is this. You pick your scientific calculator, you divide 4 by 5, you can press the equal sign. It means that answer you've got as 0.8 is supposed to, okay, that 4 divided by 5 raised the power 1/5. 1/5 means the 5th root of it. Every calculator and what it does. The calculator can show you this. Some calculators, my calculator is x raised the power like that. So if I want to do this, I'll key in the 4 divided by 5 and then equals. Then I will press raise the power. I will press this my calculator. If you do it, it will tell you answer. Then this sign comes up and the bracket opens. You say 1 divided by the 5. So 1 divided by 5 and you close the bracket. When you press the equal sign, it should give you 0.95. It should give you 0.95. Okay, so it's the calculator that you would have to use. And that is what I advise P4 students. The calculator that you would have to take to the exam room. Don't buy it just before the exam. Buy it now. Start using it. Because I'm using Casio. The application of Casio is different from the application of Sharp. So the way your Casio will function might be different from the way the other one will function. Okay, unfortunately, our time is up. Yes, it's 5 times root. It's the 5th root. So when we say something raised the power 1 divided by something, is that root of it. Okay, is that root of it. So it's the root that you're looking for. Unfortunately, our time is up and I would have to end here. But any questions that you have, you can still send them through the email. Some of you are doing very, very brilliantly. Some of the questions coming there are very good questions. Why am I saying good questions? Because they are the very challenges people are facing outside there. So the moment I see some of those questions, it tells me those guys sending those questions are really doing something good. Because I have seen almost all those questions and I know the challenges that students face. So when the question comes, I know, yes, this person is actually doing something. So don't wait the last minute before you start solving questions. Otherwise, you'll be disappointed. As I keep telling, the questions are going to bring the topics together. And as such, I will advise you to keep solving past questions. Any problem, you let me know. Okay, so thank you very much for your time. And I'll see you on Thursday for the work of combined activities. And we move on to adjusted present values. So thank you, and I'll see you on Thursday. Bye-bye for now.